right, thank you so much for being here for today's Preparing Your Storage Projects for 2026 Compliance webinar. We have a lot to cover as this is a really relevant and time-sensitive topic in our industry. As we look ahead to 2026, evolving tax code requirements, recent federal policy updates, and new incentive structures are going to directly shape how systems are purchased, deployed, and financed. So this webinar session is going to provide you with some practical guidance on just how to plan, procure, and structure projects to maximize benefits from ITC, PTC, and related incentive programs while still staying compliant with the evolving tax rules that are constantly changing, it seems. We have a really incredible group of speakers on with us today. The Washington National Tax Team has joined us. They are experts in energy-related tax, as well as federal credits and incentives. John Denninger, Senior Manager, and Sean Nelson, Senior Manager of Credits, Incentives, and Methods with the tax firm are joining us, and their knowledge of these topics is unmatched, and they're going to help answer a lot of your questions you have about compliance and tax code requirements moving forward. We are also joined by Scott D'Ambrosio. He is the VP of Sales at Energy Toolbase, and he's going to be discussing what to look out for when finding hardware, current options, and what's on the horizon for procuring equipment with Energy Toolbase. We have a lot to cover over the next hour, which I've said a couple times, including overview of 48E, all the One Big Beautiful Bill updates, including prohibited foreign entities, bonus depreciation, and more, as well as safe harboring updates, vendor updates for this year and next. But before I pass it off to the speakers, I do want to mention that this webinar is being recorded, and after the webinar is over, we're going to be sending it out to everyone, whether you attended or not. You will get that recording. We're also going to be doing our Q&A at the end of the webinar. But we understand that you might have questions pop up in your head as we're going over some of these topics. So you will see the questions tab in that GoToWebinar panel. You can type them in there throughout the webinar, and we will try to get to as many as we can at the end of the webinar. So we have a lot to get to, and I'm going to pass it over to Sean to get us started.
Okay, thank you.
I think actually I'm going to start off. My name is John Denninger. I'm a Senior Manager with RSN's Washington National Tax Group. I focus on energy and excise matters as well as federal credits and incentives. Before we start, I wanted to specify that the presentation here is meant to be general knowledge. We're not providing tax advice. If you have any specific questions, we strongly recommend that you speak to your tax advisor about them. And Sean, would you like to introduce yourself?
Yeah, so my name is Sean Nelson. I'm a Senior Manager in our Houston, Texas office. I have been working with the Energy and Excise team for over 2 years now and specializing in the prevailing wage and apprenticeship requirements, along with the domestic content requirements. So we're going to start out with just a quick review of 48E. A lot of the credits that we're dealing with now are 48E. This is the investment tax credit. This is the new investment tax credit for 2025 that replaces the old Section 48 credit. And we'll get into it a little bit later, but it does have some technologies that will be sunsetting that we'll dive into a little bit later. So this credit, just as a quick overview, provides a base credit of 6% for the qualified facility or energy storage technology. And then this credit can have a 5 times multiplier if the facility is meeting the prevailing wage and apprenticeship rules, or it qualifies for one of the available exemptions. So the other thing is that there are possible adders to this credit. So you can take that 30% all the way up to 50%, and you can do this for domestic content. Now this will actually be 2% in the event that you only get the base credit, or 10% for facilities that are located in an energy community. That also goes to 2% in the event that you're only getting the base credit. So looking at prevailing wage, obviously a 5 times multiplier is one of the largest things that happened to the credit. It took these credits from being typically 6% and so now they can go 30%. But to do that, you must be able to meet the prevailing wage and apprenticeship requirements. So just to briefly kind of give you an overview of these requirements, I just want to go into a couple things and then maybe point out what we're seeing in the market that are some of the pitfalls that we're experiencing or seeing our clients experience, just so you can be aware of those. So obviously I said, as I said, it's 5 times multiplier for the PWA requirements. So the credits that this applies to, 30C, the production tax credits, 45Q, clean hydrogen credits, clean fuel production credits, 45Z, the investment tax credit, which I mentioned before, 48 and now 48E, and then also 48C. So as a general rule, the prevailing wages are set by the Department of Labor, and those can be obtained from sam.gov for the particular area and the type of labor or mechanics that's working. Now, in the event that you're not paying prevailing wage, there are procedures to cure that. There is a requirement of making these cure payments to avoid additional penalties by doing it the last day of the calendar quarter that the underpayment was made. For example, Q3 2025 would be due October 31st. And then the 180-day payment deadline for curing, this is if the IRS gives you notice that there is underpayment. Now, the apprenticeship rules, there are 3 legs to that. The first one would be the labor hours requirement. So this is that you're meeting a 15% apprentice hours compared to total hours on the project. There is also a ratio requirement that states normally in the apprenticeship agreement that states how many journey workers are required for each apprentice or how many apprentices can work for one journey worker. There is also curing payments for situations where you're not meeting these requirements, and there is something called the good faith exception. And this is available if apprentices are not available. So some of the ways that you don't have to pay prevailing wage, and a lot of these are back before January 29th, 2023. This would be the beginning of construction. But then also the 1 megawatt exemption. If you are lower than 1 megawatt, then you are not required to follow these rules and you still get the increased credit amount. So during the process, the construction process, there are some considerations that you need to think about if you are trying to meet these requirements in order to get the larger credit. A couple that I want to point out just in pre-construction is, including this information in your contracts or following, what is in the contract. Also creating an apprenticeship plan. How are contractors and subcontractors going to meet the requirements for the apprenticeship programs that they'll be pulling apprentices from? Also, you want to make sure that any supplemental wage and labor classifications are made. A lot of times you are hiring a laborer who is not defined. And then so we would go to the Department of Labor to make sure that that they can give you a classification for that. Also, make sure that all contractors and subcontractors have a plan for how are they going to record, how are they going to keep their records so they could be obtained in the event of an audit. It's just something to think about at the very beginning of the project. Now, during construction, a couple things to point out. You want to review the prevailing wage on weekly, monthly, but definitely a quarterly basis. The reason why it's important to do that quarterly is because you can make payments for any underpayments that were made, and avoid a $5,000 per employee penalty. Making sure that you are keeping adequate records during this time, and then confirming that all the contractors and subcontractors are in compliance with all the rules. And then when the project's over, you just want to make sure that you have all the documentation that you need, or it is available upon audit. You have the required documentation that needs to be attached to the federal income tax return. And then also think about any future repairs and alterations that you may be subject to prevailing wage requirements. Just some pitfalls, what we're seeing here, determining that beginning of construction, it is different with prevailing wage and apprenticeship. So you just want to be aware of the activities that may not qualify for beginning of construction for the project, but do qualify for prevailing wage and apprenticeship requirements. Another one I want to point out again is the, who are your laborers and mechanics? We want to make sure that you're getting the correct classification for them, but you're including them in that certified payroll if they are indeed performing those kinds of duties. Apprentice prevailing wage, in the event that apprentices are outside of the ratio, you want to be aware that they need to meet prevailing wage of an electrician, for example, which is usually a lot higher. You just want to be aware of that and look out for those situations. Also, monitoring the underpayments and any penalties that you're needing to pay. Like I said, for Q3 2025, these can be made by 10/31 in order to avoid additional penalties of $5,000 per employee. Moving on to the apprenticeship. One of the biggest things we're seeing with the apprenticeship rules right now is being out of the ratio requirement. So a lot of times it's 1-to-1 journey worker per apprentice, but sometimes it's 2-to-1 or 3-to-1. You want to be aware what's required by the apprenticeship shop, and make sure that you're following that, because if you have an apprentice that is outside of that ratio, they are required to be paid a prevailing wage. Also, making sure that you have the documentation that they are indeed part of this program. Usually that's an apprenticeship card or something like that. Those are the documentations that you want to make sure that you're keeping. And then finally, the record keeping. This is the items that will demonstrate that you tried to meet prevailing wage. There's no intentional disregard, which could be a 10 times penalties for these. So make sure that you are collecting this in real time. It's a lot harder to get this information when you're going back and looking for stuff that was years old. Also, those correction payments, failing to make those and keeping documentation that those were made, could result in these intentional disregard payments.
All right. I'm going to talk about the One Big Beautiful Bill Act and the changes that resulted from that. I'm going to refer to it as OB3 because OBBPA is too many B's and OB cubed is just a strange way to say it. So first, we're going to talk about the changes as it relates for early termination and some of the technologies within 45Y and 48E. Next slide, please. Thanks. So for both 45Y and 48E are pretty similar credits. Y is the production credit, so that it's a credit related to the electricity produced, whereas E is an investment tax credit, and so you get a credit based on the value of the property. So initially, both credits terminated the later of 2032, or when emissions rates reached 25% of what they were in 2022. That changed. Now it's just straight 2032, and that's when the credit terminates. If history repeats itself, oftentimes dates like this for credits like this, like these, get extended out over time. So while there is currently a hard 2032 deadline or ending date, that may not ultimately be the case. Most importantly is that the termination date for wind and solar facilities, specifically wind and solar, is now where they must be placed in service no later than December 31st, 2027. So they obviously terminate much sooner. There's an exception to that because placed in service is always difficult to judge when you're in the midst of construction and planning. And there's an exception here where if these facilities begin construction by prior to July 4th, 2026, the 2027 placed in service date doesn't apply. Next, we're going to talk about my favorite topic, the prohibited foreign entities. I say that jokingly because it's very complex and challenging. Next slide, Sean. So the concept of prohibited foreign entities is a new one. A lot of people refer to it as the FEOC rules. FEOC was around previously under IRA sections. These rules are different and broader, and so I prefer to call them prohibited foreign entities just to make sure it's clear that what it is we're talking about. So a prohibited foreign entity is prohibited from claiming either 45Y or 48E, the tech-neutral credits, as well as a few other credits. These rules primarily focus on control and influence over the taxpayer wishing to claim the credit, rather than, not necessarily where construction or something is occurring. It's really just how much control and influence they have over the credit claimant. Right now, there's no guidance out for the PFE rules. Some of you may be aware that on July 7th, President Trump issued an executive order directing Treasury and the IRS to issue guidance within 45 days of passage of OB3. That obviously did not happen, and we're still waiting on it. I don't know when that date will be. My guess is that they're working on proposed regulations, although that's purely my own guess. And so if that's the case, I wouldn't expect any guidance to be out before probably December of this year, and that's probably pushing it. So a prohibited foreign entity, Sean, if you go to the next slide, is either a specified foreign entity or a foreign influenced entity. Specified foreign entities, really it just boils down to, are they a foreign controlled entity, which means they are, in North Korea, China, Russia, or Iran. Obviously, the country here with the greatest area, or with the most exposure for energy, is China. There are a lot of energy companies that are owned by, or companies owned by Chinese companies. So that's kind of that's probably the biggest area where there's probably risk. A foreign influence entity is also really coming down to control, and that's where if any of these specified foreign entities are able to appoint what's called the covered officer. That would basically be someone in a leadership position, such as a board of director, executives, C-level executives generally, as well as like executive vice presidents. It's also where a single specified foreign entity owns at least 25% of the foreign influence entity, or multiple specified foreign entities own at least 40% in the aggregate of the FIE, or if the SFE owns 15% of the debt of the FIE. And that's how you determine whether or not there is a foreign influence entity in the current tax year. There's also a provision where you have to look to the prior tax year. And in that case, it's where the FIE is able to exercise control over that qualified facility in this case, because we're talking about 48E. And so that, Sean, if you can go to the next slide, is really a test of how much control there is, what they're able to influence, and what sort of authority they have over that qualified facility. And the things that show that there is effective control are various agreements that you look to that dictate the timing of the energy production, who can purchase the output of electricity, who has access to data, who has exclusive rights to operate or maintain the facility. There's also, you also look to licensing agreements and who owns the IP related to the facility's functions, who has control over the service provisions and all kinds of restrictions. So it's really looking to who is able to dictate decisions and control of a qualified facility. So these, and it's important to point out that these are agreements that don't necessarily apply, that don't necessarily relate to ownership. So you have to look to those underlying agreements as well. There is a exception, I guess, to what's considered a prohibited foreign entity, and those are certain publicly traded entities. And these are pretty involved rules. And so the most important thing is that if you come across a scenario like this, where you are dealing with a entity that says they are publicly traded and so these rules don't apply to them, or if you yourself might be in a scenario where you believe you're publicly traded, even though there might be some ownership by a prohibited foreign entity, it's really important to consult with a probably securities regs attorney, because it really the exception here really looks to whether the entity has securities that are regularly traded on a registered exchange. There are also issues related to ownership, tiering of ownership, where the final owner, their securities are traded on an exchange. But it's also important to point out that if the exchange itself is located in any of these prohibited foreign entities, or these foreign influence entities, or foreign entities rather, or foreign countries, those exchanges don't count towards this. So this is something where you should absolutely talk to a tax advisor and probably a securities regs attorney, because they're really complex, and you don't want to make that mistake. Sean, can you go to the next slide? So next, we're going to talk about material assistance from a prohibited foreign entity. So this is a very new issue that hasn't really been around in any form previously. So here, if the facility that is trying to claim the credit is receiving or is made up of equipment from a prohibited foreign entity at a certain percentage, then the entity trying to claim the credit can't claim it. They are prohibited from doing so. While it says material assistance and it sounds like it means that the prohibited foreign entity is sort of helping out or in some way involved in the construction, all that it really means is that they are a vendor whose equipment ended up in the qualified facility. So as you can see, the percentages vary over time and differ depending on sort of the type of facility itself. So there's a difference, the percentages differ between a qualified facility or energy storage technology. Energy storage technology also would include something like a battery energy storage system. And it increases over time, ultimately reaching the peak for facilities that begin construction after 2029. And another important distinction here is that it doesn't necessarily matter where the equipment itself is manufactured. It matters more who it is that is manufacturing the equipment. So imagine a scenario where a company that builds, I'm just going to say battery energy storage, they have their manufacturing site in Russia, but that entity is fully owned by US owners. In that scenario, that probably would not be a prohibited foreign entity. And so even though the battery energy storage system is manufactured in a foreign country that is itself, one of these entities that is considered a foreign controlled entity, it probably would not count towards this percentage. So instead it would be considered prohibited foreign entity manufactured products. Another thing to point out is that the material assistance rules apply to facilities that begin construction beginning in 2026. So if construction begins now or before the end of the year, these rules don't apply. So that is the case no matter what type of facility it is. If construction begins at this moment or before the end of this calendar year, the material assistance rules themselves do not apply. Sean, can you go to the next slide, please? So similar to the general prohibited foreign entity rules, the IRS has not provided any guidance yet. Currently within the statute, it says that taxpayers can utilize some provisions that relate to domestic content. So backing up a minute, within the statute, it says that Treasury and IRS have to issue a safe harbor table within a certain set of time. In the statute, it says, I believe, the end of 2026, so December 31st, 2026. Before then, taxpayers can rely on some of the domestic content guidance that relates to the makeup of facilities. However, and I should add, there is a problem here with that. So the whole purpose of the safe harbor provisions for domestic content was that taxpayers were having a really difficult time determining what their direct costs were that make up the facilities. They were buying something from a vendor, and obviously sellers don't necessarily want to tell you what their direct costs are, because then it shows what their margin is, and so that's a hard thing to give up. And I used to be at IRS, and I helped work on some of the guidance there, including domestic content, and it became apparent that taxpayers were just not getting some of the direct cost information that they needed in order to comply and ensure that they were meeting domestic content rules. And so we worked with the Department of Energy to basically a survey of the industry and come up with sort of general numbers for different components that go into certain qualified facilities. And taxpayers could rely on those numbers and use them to meet domestic content. And that would mean that they never actually got the direct cost information. Here, they can still use that same safe harbor table. So there have been a couple that came out. The most recent one came out back in January of this year. Again, it's just percentages. It's not actually numbers. But what the statute says for material assistance is that if you do that, you use that safe harbor table, you still have to have a signed certification from the supplier. And the statute provides like what needs to be within that certification statement. And what is confusing, and I think even contradictory, is that it requires the supplier to state that the property was not produced by a prohibited foreign entity, and the total direct costs associated with the manufactured products that are not produced by a PFE. So the result is you can use the safe harbor table where you don't have direct cost information, but then you have to have the certification statement, which requires the direct cost information. And it's a real disconnect, and I don't really know how that's going to work. I think that's something that, or I expect that that's something that people over at Treasury and IRS are grappling with right now, and I don't know what's going to come out of that. Sean, can you go to the next slide? And there are a few more changes to 48E and 45Y. Can you go to the next slide, Sean? So specific to the tech neutral credits, there is potentially an easier way. So I should say for the tech neutral credits, one of the requirements for them is that the facility itself does not have, has a 0 greenhouse gas emissions rate, or less than 0, I think is what it actually says. And obviously for a number of technologies, that can be very difficult to meet. While working on the regulations for the tech neutral credits, one thing, previously it said, you know, there was a table that the IRS had to come out with, or if technology wasn't on that table, comes out annually, a taxpayer could go through Department of Energy and get a preliminary emissions request that provided them with that information. The change for OB3 is that now Treasury has to consider existing studies to demonstrate that there's a net life cycle greenhouse gas emissions rate that is not greater than 0 using accepted life cycle assessment concepts. So what that means is studies that aren't done by DOE, I think the statute specifically references ISO studies. If those studies would show that there's a 0 greenhouse gas emissions rate, Treasury has to consider that. And so that means that it might be easier for some technologies to get a sufficient greenhouse gas emissions rate that they could claim the credit. The next one, and this one's kind of in the weeds, they're within both credits, 45Y and 48E, you can claim the credit for a brand new facility, or if it's an existing facility and all that's happening is you're increasing your electricity production, you can claim a credit for that incremental production. And one thing we didn't want to do while drafting the guidance was, for the regulations, was allow an independent professional engineer to say that there was a increase, because we were just worried about, you know, someone that maybe a not terribly honest professional engineer providing a report saying that you know, there was stating what the production was. That changed. Now that is allowed by statute. Finally, qualified fuel cells are explicitly included under 48E now. However, they are at a 30% credit rate. They don't have that 6%, and they also don't have to meet the greenhouse gas emissions rate. But because they're at 30% and they're only at 30%, they cannot get the bonuses for domestic content or energy communities, but they also don't necessarily have to meet the prevailing wage rules. All right, Sean, next slide, please. Okay, finally, bonus depreciation. Next slide, Sean. The bonus depreciation phased out, but now it's back. 100% depreciation is available for certain property the year it's placed in service. This is generally property that has a recovery period of 20 years or less. Anything that qualifies under 45Y or 48E has is considered 5-year property, so it's eligible for bonus depreciation. There's a little bit of a confusing area right here where if a facility is owned by a prohibited foreign entity or it fails to meet the material assistance rules, it's probably not considered a qualified facility. And so it's a little bit unclear what happens then. I think the right answer is that it wouldn't be able to qualify for 45Y or 48E, but it would still be eligible for bonus depreciation. You'd have to, again, this is something we want to consult with your tax advisor to make sure your specific facility meets the rules, because you're going back to the old, really old depreciation schedule rules. And so long as the facility would still have a recovery period of 20 years or less, it would remain eligible for bonus depreciation. Next slide, Sean. Okay, moving on to safe harbors. Next slide, Sean. So the important thing to consider for safe harbors is that a safe harbor it's a common term used throughout tax. It doesn't necessarily relate to energy issues, but there are several safe harbors that relate to these provisions. So there are 2 that are relevant for domestic content. There's a classification safe harbor that's been around since the first notice came out for domestic content. There's also a cost percentage safe harbor that I sort of referred to a little bit ago about the percentages that can be used to determine if a facility meets domestic content. I also mentioned that there is a safe harbor table for material assistance. We don't know what that table is going to look like yet, but it'll come out at some point. And then finally, there are 3 safe harbors that relate to beginning of construction. There's that beginning of construction safe harbor for solar and wind, simply to qualify for the credits and avoid having to deal with the placed in service date of 2027. There's also a 5% safe harbor that we'll talk about in a couple minutes, and then also a continuity safe harbor. So keep in mind, when we say safe harbor, that can mean a lot of different things, and we'll talk about each of them now. Next slide, Sean. So first up is domestic content. And just a quick refresher on what domestic content is. Next slide, Sean. Domestic content is a credit adder. So if you don't meet domestic content, it doesn't mean that you can never claim the credit. It just means you can't claim the credit at as high of a rate. So for domestic content, all structural steel or iron that makes up the qualified facility has to be fully domestically sourced. It has to come from the United States, no exceptions at all. For manufactured products that make up the applicable project or the qualified facility, these are things that have to be deemed to be produced in the US. And if they're deemed to be produced in the US, then you can claim the credit, or you can claim the domestic content bonus. So the adjusted percentage varies over time for 45Y and 48E. Some of you might be aware that previously the domestic content percentage for 48E was a little bit wrong. There was a mistake that was in the law when Congress passed IRA. That was changed under OB3. So now the adjusted percentage for both 45Y and 48E are the same. And here, where construction begins prior to 2025, it is 40%, and up to 55% for construction that begins in 2027 or later. Sean, next slide, please. So here are the 2 safe harbors for domestic content. The first one is just a classification safe harbor. What exactly is a manufactured product is kind of a hard question. For certain technologies, there were tables that were added to the first notice. It was 2023-38. And those tables, all they did was say like solar and wind, and you'll see an example on the next slide. For solar and wind, or for a solar facility, this item is a manufactured product, this item is a manufactured product, and this item is structural steel or iron. So it wasn't anything more than that. And there were a few technologies also besides solar that were listed out that way. Later, and as I referred to it previously, it became apparent that taxpayers just were not getting the direct cost information that they needed in order to comply with domestic content rules. And so beginning with the second domestic content notice, 2024-44, there were a series of tables with percentages for the different manufactured products that made up that table and that technology. And then the most recent one is 2025-8. And these provide that cost breakdown so that a taxpayer doesn't have to get direct costs. They can use this table and they're able to determine that they meet domestic content. So this is an example of the safe harbor for battery energy storage. This is the table from the most recent notice, 2025-8. So as you can see here, these are 2 different types of BESS systems, and the APC is what is the term used for a manufactured product. So for a BESS system, the manufactured products are the battery pack, the inverter, the battery container and housing, and then the steel and iron would be related to the foundation, the steel and iron that's in the cement pad. And the numbers are just percentages, and you just add them up. And if you get over the threshold for that particular tax year when construction began, so long as you can show that so long as it adds up to the appropriate amount, you're able to claim the domestic content bonus. So it's as simple as that. And often vendors will provide a memo that specifies what parts of their equipment meet domestic content and how it relates to these tables, rather than even wanting to give you domestic or their direct costs themselves. Next slide, Sean. So the safe harbor for material assistance, as I mentioned, there has to be, Treasury has to issue a safe harbor table. Next slide, Sean. Thank you. They have to issue a table. They're directed by law to issue a table by December 31st, 2026. Before that, taxpayers can use the tables that were from that 2025 notice to determine the direct cost ratio. They also have to obtain that certification statement, and it really is unclear how this is going to work. It doesn't make a lot of sense to me to utilize a table, a safe harbor table. Because remember, a safe harbor table is just that if you follow this, IRS isn't going to challenge you. If you disagree with how the table lays it out, these percentages, and you do get direct costs, maybe you can show that your direct costs related to one item is substantially more than the total cost of your own facility and the facility you're claiming a credit for. And so if you do that, you can ignore these safe harbor tables. But it's really unclear how you can use a safe harbor table where you don't get direct costs, but then also use a certification statement that requires direct costs. So I don't know how this is going to work, and I hope Treasury answers that question soon, because I'm curious. Next slide, Sean. Okay, now we're going to talk about beginning of construction. Like I said before, there are a few safe harbors for beginning of construction. So just a reminder, after OB3, the solar and wind facilities specifically must be placed in service no later than December 31st, 2027. But there is a safe harbor for solar or wind facility, if it begins construction prior to July 4th, 2026. The IRS, next slide, please, Sean, has issued a whole lot of beginning of construction notices, providing information about what is beginning of construction, and it boils down to either the physical work test, where you physically begin construction, or the 5% safe harbor. Again, safe harbor. Previously, beginning of construction didn't really matter for tech neutral, but it does now, specifically for solar and wind, whether they can avoid that placed in service deadline of 2027, and as a way to avoid the material assistance rules potentially. So we'll talk about it a little bit more. The availability of some of these safe harbors, or these beginning of construction determination manners, has changed a little bit. Now the 5% safe harbor isn't available for a wind facility, although it is available for certain low output solar facilities. And if it's not those two, so it's not wind or solar, the 5% safe harbor would still be available. So the physical work test is related to construction. When does actual construction begin? And there are, the work can be performed by the taxpayer, or it can be performed by a engineering company, EPC, under a binding written contract. The work has to be significant in nature, and the test is looking at what the work is rather than the cost or the amount of the work. And the work could be on-site or off-site. So there are certain scenarios where if you begin construction off-site, so someone's constructing something, that can count towards the beginning of construction. An important note for that is that if it's construction off-site, the item that is being constructed can't be generally an inventory by the manufacturer off-site. So that would exclude certain things, like generally a solar module is inventory for the manufacturer. But there are things like solar racking where maybe it is, maybe it isn't. It really depends on the manufacturer itself. Some solar racking is built really to spec for the project, and so that wouldn't probably be considered inventory. And as a result, sometimes that can be treated as off-site construction. For these, the taxpayer has to make continuous progress once completion begins. Next slide, please, Sean. So like I said, for the safe harbor, as it relates to solar and wind, the 5% safe harbor is no longer available for a wind facility. It is available for a low output solar facility. A low output solar facility is one that doesn't generate more than 1.5 megawatts of electricity measured in AC. The 5% here is the total cost of that facility. So if there are cost overruns, that would count towards the denominator. And so generally, when we're working with a client, we try to be a little conservative, and we assume it needs to be something like 7.5% to avoid a scenario where you make a mistake down the road and ultimately blow the 5%. Again, one thing to point out, this is the guidance that came out was specific to solar and wind. There is previous guidance that says these beginning of construction rules are applicable for the tech neutral credits. So that means something like a battery energy storage system would be able to still utilize the 5% safe harbor. Next slide, please, Sean. So both of these beginning of construction rules require a continuous program of construction, or the continuity requirement. Generally, this is the facts and circumstances test. There are scenarios where there can be a delay in construction where nothing is going on. There's a disruption, and the IRS has provided a non-exclusive list of activities, things like permitting issues or availability of a piece of equipment, labor issues. Those can avoid those count as excusable disruptions generally. But again, it's a facts and circumstances determination. So if that were to happen to you, I strongly recommend that you talk to your tax advisor. There is a continuity safe harbor. So here, if the facility begins construction and it is placed in service by the end of the calendar year, that is no more than 4 calendar years after construction began, then it's deemed to meet the continuity requirement, even if there was a delay of 2 years in there. And that doesn't matter. As long as you get it in service within 4 years, you're okay. I want to point out that the 4-year requirement is specific to the continuity safe harbor. If a taxpayer is not going to rely on that safe harbor, it can take longer than 4 years, so long as that they are showing a continuous program of construction. That question tends to come up a lot. Next slide, Sean. Okay, I want to provide some important deadlines. Next slide, Sean. So first off, we have the material assistance rules that begin to apply, and that's January 1st, 2026. If the facility begins construction prior to that, they don't. The prohibited foreign entity rules generally probably begin applying then. It's really dependent on the specific taxpayer. The effective date for those rules are the first taxable year that is after OB3 passed. So if the taxpayer is on a calendar year, it would be January 1st. The beginning of construction safe harbor for solar and wind ends July 4th. So any facilities that begin construction after July 4th, they have to meet the placed in service deadline, which is December 31st, 2027. And if they miss that date and they didn't meet the beginning of construction date, then they're not eligible for the technical credits. And then finally, currently the technical credits begin to phase out. The first date is at the end of or in 2032. The amount of the credit you can claim begins to reduce over the subsequent 3 years. So it's important that if a facility is wanting to get the full credit, they begin construction no later than January 1st, 2032. think with that, we are turning it over to Scott at Energy Toolbase.
All right, thank you so much. Hello, everyone. Thank you for joining us today. We truly appreciate you taking time out of your busy schedules to be here. Special thanks to Sean and John from Washington National. Really appreciate you sharing your knowledge, your expertise at such a crucial time for our industry. And of course, thank you, Tracy, for setting this up. As always, you've done a phenomenal job. My name is Scott D'Ambrosio. I'm the Vice President of Sales here at Energy Toolbase. I oversee our sales organization supporting our 3 core product lines: ETB Developer, ETB Controller, and ETB Monitor. Anyone new to us, ETB stands for Energy Toolbase. We'll dig in a little later into what each of these products does and their competitive advantages and how they fit into the evolving landscape of FEOC 2026, safe harboring of policies of 2025. Before we continue, I want to be clear, I'm not a tax professional. Nothing I share should be interpreted as tax advice. Please consult your own tax advisor. I've been with Energy Toolbase for over a decade, and there's one thing I learned. It's that the only constant in this industry is change. Our industry is resilient, adaptable, and always finds a way to move forward. This year brought major policy shifts, plenty of uncertainty, but as we've shown, collective strength and our ability to pivot when needed. My hope is today's webinar gives you practical insight to help guide your business through these transitions. And over that time, we can earn your trust, your business, and partnership. Renewable energy industry is still beginning of its growth curve. The grid is outdated, utility structures keep evolving, and the demand for clean, sustainable energy continues to rise. Now, depends on having the tools. Success now depends on having the tools that we could simplify the complexities, deliver accurate and transparent results, adapt with policy changes, and track performance in real time. That's exactly where Energy Toolbase comes in, helping developers, asset owners, and partners navigate the rapid changing landscape with clarity, precision, and confidence. Another key advantage of Energy Toolbase is our strength and stability as a company. We're owned by and backed by a company called Pason Systems, a global energy technology company with over 40 years of history, $1 billion market cap, traded on the Toronto Stock Exchange. I mention this because over the year, we've seen companies in the industry, not just startups, but well-established companies come and go. Projects get stranded, service contracts lapse, customers are left without support and not knowing what to do. That's not who we are. Our partnership with Pason gives us financial strength, operational backbone, and staying power to support your projects for the long term. When you choose Energy Toolbase, you're choosing a partner built for longevity, reliability, sustained performance, not just today, for the life cycle of your project. Next slide. ETB Developer is a cloud-based renewable energy software built to simplify and streamline the process of designing, modeling, and deploying renewable energy projects. Your journey starts with Developer. It provides a user-friendly interface that allows you to create detailed project models, analyze data, and generate beautiful, customizable reports. We thrive in complexity and present it simply to our user base, always leading with accuracy and transparency. ETB Developer is recognized as the industry gold standard for avoided cost analysis, rate analysis, and financial analysis for your solar, storage, and hybrid projects. I'm not announcing anything new today on the platform, but just saying there's a lot of excited innovation ahead, and you expect new technologies and advanced modeling capabilities coming next year. Next slide. ETB Controller is our energy management system, the intelligent layer that brings a battery hardware to life, unlocking their full economic and financial potential for asset owners. It's a flexible solution that fits a wide range of projects. We offer 2 core versions: ETB Controller, a simplified, cost-effective controller that executes battery dispatch based on schedule you define, and ETB Controller with Acumen AI, our advanced, fully autonomous version of co-optimization of bill savings and grid services, uses machine learning, predictive algorithms. It continues to forecast weather, load, solar production, utility rates, net metering, grid services, learning and adapting over time, maximizing your project return. This is where intelligence of our platform truly shines. The same algorithms that we optimize for real-world dispatch power ETB Developer. This means what you modeled is really what you get in the field. When you're using ETB Developer, it's not cheating, using historical data, creating a perfect dispatch. It's using our actual algorithms we deploy in the field, giving you a true digital twin. And finally, we have ETB Monitor, because let's face it, deployment is just step one. The real value of your solar and storage begins after installation, when you can actually prove the system's performing and delivering the value that you promise your customer. ETB Monitor gives you real-time visibility, financial transparency, post-project savings all in one place. It also provides fleet-wide control, alerting, diagnostics, so you can track your performance and address those issues proactively. At the end of the day, ETB Monitor delivers the truth and clarity, removing the black box around system performance, giving you full confidence that your projects are running exactly how they're supposed to be and how they were modeled. I want to highlight one part of Energy Toolbase that doesn't always show up in demos, the brochures or the slide decks, and that's the people behind the platform. ETB provides a suite of industry-leading software tools that help you grow, execute on your opportunities, but what truly sets us apart is the data, the expertise, and the team behind those tools. Our professional service division brings in human expertise together, combining consulting, data, and support into one unified team. Quick response is essential to our users, so we added this as an additional layer to our support, to our sales team, helping from everything from technical modeling to post-project assistance. ETB Consulting, not sure if you knew this, but we have a consulting arm. This is where they create for developers, asset owners, or partners proposals with tailored designs, optimized storage strategies, actionable insight that maximize your return. Our team delivers speed, accuracy, and deep market expertise, helping you navigate complex utility structures, net metering, incentives, and policies, so you and your customer can make confident, quick decisions. After the webinar, we'll send you an output of what the consulting team produces and making sure that you have an opportunity to interact with them. One of the most powerful assets within the Energy Toolbase ecosystem is our in-house utility rate database. We own and maintain the most granular, accurate commercial rate database in the market, with over 120,000 rates globally across 72 different countries. That rate data powers all three of our core products, ensuring consistency, accuracy from design through operation. Looking ahead, expanding these capabilities even further, we'll offer new services like utility bill verification, other data-driven tools to help you validate your project performance. And lastly, I want to highlight, next slide, our operations team. Because customer service doesn't stop once you get a PO. Our operation team is an interactive, responsive, proactive group. They lead each of these projects through a defined process with a series of technical meetings to ensure a smooth, successful deployment. Once these systems are live, our team of engineers are constantly monitoring these sites to make sure performance is as expected. If there's issues arise, we work closely towards a resolution. ETB Monitor and our fleet of engineers have real-time visibility across our portfolio. If any alerts or triggers, we try to resolve these through auto fault resolution. If that's not possible, we immediately open a support ticket with our vendors. Thanks to our deep relationships and regular cadences with our hardware partners, we're able to triage and resolve these issues quickly. It's a hands-on, high-touch approach that ensures every project we support doesn't just get installed, but it stays optimized and supported for the long term. Next slide. As we approach the end of the year, time is of the essence, and anyone looking to safe harbor projects before 2026, we get a lot of questions. How do we establish a binding contract or order equipment through ETB to meet your own safe harbor approach? Here's the stuff that you need to know. Over the years, we've completed more than 25 different battery integrations. Throughout that process, we learned what is a good partner with proven technologies, responsive support, and long-term stability. We don't take integrations lightly. We're selective about our partners and align the equipment that we stand behind. For 2025, our current Energy Toolbase portfolio includes Tesla, Socomec, Solarc, and BYD. All these systems are fully integrated into the ETB ecosystem, meaning they can be accurately modeled, deployed, and monitored. Tesla, we integrate directly to the Megapack 2. There's 43 configurable setups that you can model and order that range from a 326 kW to a 1927 kW. 1284 kWh to 3916 for a fully populated megapack. These can be run in parallel and controlled by one Acumen controller. Tesla provides optionality and warranty length. Cell origination, they have domestic and Chinese cells, options in O&M, microgrid capabilities, and uniquely allowed to operate near salt water without voiding the warranty. Current lead times tracking Q3, Q4 of 2026, assuming Tesla's full process is followed. Be cautious of anybody telling you or promising you faster lead times. Tesla has a process, a defined timeline, and structure, and they're very precise. I'm stating you realistic timelines. Socomec. We're proud to be the #1 reseller of Socomec HES systems in North America. Socomec is a French manufacturer with over 100 years of history in the power space. Socomec is known for quality and reliability. They offer 2 distinct products, HESL and XXL. The L ranges from 50 kW all the way up to 550 kW. Capacity is 203 to 1218 kWh. They're configurable and stackable. They're larger systems called XXL. The power ranges from 500 to 1500 kW, 1628 kWh, all the way up to 6105 kWh. They offer optionality within warranty up to 20 years, preventative maintenance packages, as well microgrid capabilities. Lead time 6 to 8 months. There are a couple of units available for Q1 delivery, first come, first served, and then we're planning to deliver in Q2 2026. SolarArc, that's our partner for more of those smaller, medium-sized commercial opportunities. They offer a wide range from 30 kW to 60 kW, 60 kWh to 360 kWh. Very configurable, microgrid compatible, proven for coastal sites. They have a very simple maintenance requirements, which is awesome. They maintain short lead times thanks to their domestic inventory, typical shipping times, 1 to 2 months. All right, this next part is important. I want to walk you through exactly how to move forward with Energy Toolbase. To get to a contract, we need to generate a quote. Requesting a quote, we need basic information about your opportunity, project name, size, vendor, application, your delivery expectation, and site address. Once we have all that information, our team is able to issue a formal ETB quote. These quotes are valid for 21 days. Moving a quote to a contract. After you receive your quote, the next step depends slightly different on the vendor, but this general process applies. Complete the vendor-specific tasks required for that system. Our ESS experts will support and guide you through that process. Issue a purchase order referencing the ETB quote number, and once we receive your purchase order, we will then send an invoice and collect that notice to proceed payment. At that point, you have a contract in place with Energy Toolbase. All purchase orders must be submitted before December 12th, 2025. That gives us ample time to process, confirm, and secure your equipment. If it's after that, we will still try, but no guarantees. How to contact us, it's on the screen right here. You have multiple options. If you're an Energy Toolbase user, you can contact your account manager. You could hit the proceed to quote button in ETB developer. You could email us. If you're not a ETB user, use this QR code here, and you will be scheduling a meeting with our ESS experts, answering any questions and guiding you to the next steps. And a final note, ordering systems is a process. This window is tight. Please don't wait till it's too late. Reach out now, get your quotes started, and let's make sure your projects are contracted. All right, next slide. Let's talk about 2026 and what to expect. As we look ahead at 2026, it's clear we're entering a different world. Historically, it's always been solar plus storage. Moving forward, it's going to be storage plus solar. This is a real shift, and it's going to reshape how projects are modeled, sold, and delivered. We understand that energy storage can be new to some teams and new territories. That's why Energy Toolbases offer a plethora of different types of training, one-on-one, webinars, group sessions, lunch and learn. Let us know. We're happy to set that up with your team. We want to work with you. We want to do some trainings. Expanding the platform, and I'm proud to announce and share bringing new hardware options in 2026 that we've been partnering, talking to, and validating for a long time. One of Energy Toolbase's biggest competitive advantages is no vendor lock-in. We believe you should have the freedom to choose the right hardware for each opportunity, not be tied to one single OEM. We have not received any attestation documentation confirming FEOC percentages, but I'm going to share what I know working close with these partners and the strategic directions for 2026. You'll notice there's 2 really distinct paths we're seeing our vendors take. ones that are actively pursuing FEOC and ownership compliance, and other vendors who are not, but they will continue to offer a strong, low-cost, non-compliant option. On the screen here, you'll see our partners that we're bringing live here in 2026. Generac, longstanding leader in backup power. We're excited to onboard their energy storage units. With our planned microgrid modeling capabilities launching in 2026, we see strong strategic fit, and we value that partnership. SMA, we've worked with SMA for years, and we're expecting them to commercialize behind the meter solution that is FEOC compliant. SMA has been known for reliable engineering quality, and we're proud to be among their premier partners. Socomec is going to bring a skid-based solution designed for FEOC compliance. We're still awaiting final documentation, but before publishing that to the platform, we want to make sure we have all that appropriate information. And whatever Socomec delivers, we know it'll meet their usual standards of quality and precision. And lastly, being FEOC compliant, we got Tesla. The Megapack offers domestic cell options. And as always, Tesla's organization, documentation, and execution is second to none. We're excited to collect and share that updated compliance documentation as soon as it is released. Well, then you have the other approach. Oh, 1 second. And then you have the other approach that's non-FEOC systems. And these are going to be our partners, SunGrow, who's going to offer 2 different system configurations for their Stack and Titan 2.0. We got Risen SYL that's going to offer 2 solutions on our platform. We still got our partners here at Solarc for the small and medium, and then see what BYD does. We'll see if their new chest unit comes out to hit market or not. The key advantage of non-FEOC systems are lower price point. The greatest benefit of Energy Toolbase is you can model those hardware options side by side, have one have the ITC, one not have the ITC, see the financial impacts, input the cost on there, and be able to do that comparison side by side. And as we close here, I want to thank everyone for joining. A special thanks to John and Sean. We really appreciate your time. Our industry is changing fast, and in 2026 is a defining year. At Energy Toolbase, our focus is simple. We want to help you stay ahead with accurate modeling, intelligent controls, transparent monitoring. We give you the tools and the team to turn complexity into confidence. The deadlines are real, the opportunities are here, and now is the time to move forward together. Thank you.
All right, thank you, Scott. I'm going through these questions, and I know we have a lot of questions. We're not going to get to all of them. That just is what it is. But I am going to start with a couple and get what we can get through. So we had one. This will probably be for John and Sean. If you safe harbor a project, you have to take delivery of the ESS within 105 days.
I'm not aware of there being any sort of deadline like that. So long as you've made the payment, then it should be that you are able to meet the 5% safe harbor for heated construction.
Awesome, thank you. I'm going to throw a few more. For the beginning of construction, safe harbor, what are examples of activities considered of a significant nature?
That's really a facts and circumstances test, so it's hard to say precisely what it might be. There are some things like sort of landscaping or just very insignificant, we'll say, earth moving that aren't considered beginning of construction. There's kind of a non-exclusive list that's in some of the guidance. But if you're going to rely on the physical work test, it's important again that you talk to a tax advisor for your specific facts.
Awesome. Somebody asked, can you safe harbor FEOC without physical work beginning in 2025?
So the answer to that is yes. The 5% safe harbor is still available. Well, sort of. You can, for a solar facility that is the 1 megawatt or less, you cannot. The 5% safe harbor does not apply for a large solar facility that's more than 1.5 megawatts. It's not available for a wind facility. It is otherwise available for other technologies, so like a battery energy storage system. The 5% safe harbor is available, and so if you use the 5% safe harbor and you begin construction before the end of 2025, you should be able to do that. Specify, I want to make clear though, IRS has not issued any guidance on that. It does seem like though it is still available based on everything that's out so far.
Awesome, thank you. Scott, this is probably one for you. What are the mistakes that we're seeing developers make when contracting ESS projects in this current state?
I think one of the biggest mistakes I see is setting the expectations of the customer falsely. That's always an issue. It's always a headache. And there's two different things that I see is one, somebody being really loose with their modeling and putting something in front of an end customer that is incorrect. And the other is when they're using our platform and they're modeling our systems using our control algorithms and then not achieving that savings in the field because they didn't deploy our controls, they deployed somebody else's controls. And there's a huge difference, right? You know, from solar panel, right? There's not huge deviations, right, from the performance or the output, but EMS algorithms, it's a completely different world. So there is vast differences from different EMS partners. I'm proud of our experience and I'm proud of our performance, and we're constantly auditing our sites to match what is being modeled in our platform.
I guess this is a good segue for this question is, can ETB's controls be used on systems that weren't presented in today's webinar?
Oh, great question. We have done 25 different battery integrations historically. So if you don't see one on there, there's a chance we're already integrated with it. We are open to expanding our partnerships, but we do look for tier 1 solutions that have the tier 1 support tied to it. So we're always interested in expanding the fleet and getting into those conversations, and we'll consider it one by one. So please reach out to us and we're happy to consider.
Thank you, Scott. John, Sean, somebody just asked, beginning of construction, safe harbor is continuous and 4 years. Can you take 4 years and still be considered continuous?
If you have your facility placed in service within 4 years after you begin construction, again, even if you have a delay in that 4 years, you're deemed to meet the continuity safe harbor. If you have been continuously, so that means, I guess, yes, as long as it's within 4 years. If you go longer than 4 years and you are able to show that there was that continuous construction, true continuous construction based on the facts, you can potentially still qualify for the continuity requirement. So again, the 4 years is specific to the continuity safe harbor, not the continuity requirement itself.
Thanks, John. This one probably for you guys as well. Does ESS system size affect how you safe harbor? Do solar and storage get added together for cost basis?
So under 48E, it used to be that there was something called an energy project, and that was under the old ITC. That's a concept that doesn't really apply anymore for 48 cap E. They're separate credits. So it generally doesn't. There are some exceptions related to determining whether or not you are going to meet the prevailing wage and apprenticeship exception under, for the 1 megawatt exception. So again, when you start getting into like really specific questions like this, it's always important to talk to a tax advisor. But I guess the answer is probably not, but maybe, depending on what's going on. So sorry for the non-answer.
It's okay. But yeah, a lot of questions. And again, we're skipping this project specific questions. We will get to those after the webinar. I do want to ask just a couple more. A couple people have asked, and I know you might have covered it already, but what additional guidance are we still waiting on from the government, and how is that going to potentially change what we're talking about today?
So there still has not been any guidance related to the prohibited foreign entity rules or the material assistance rules. The rules generally are not retroactive. So if IRS comes out with a notice, we'll say tomorrow, that made everything I just said wrong, it should be on a go-forward basis rather than retroactive. So we're waiting on something for that. I don't know what that guidance is going to look like, whether it'll be regulations or if it'll be just a notice. So it's hard to say. There probably will be some other changes to the final regulations for 48E, but I genuinely don't know if IRS is even working on that because there's a shutdown right now.
All right, I do want to just ask one more question because we have gotten this one several times throughout today and also from our customers beforehand, but is 100% bonus depreciation available for only FEOC compliant ESS projects, or can non-compliant systems also qualify for full depreciation?
I think the answer is yes. I think that there is a little bit on lack of clarity within the law itself that hopefully Treasury will answer. I think, though, that you're probably able to still show that a non-prohibited foreign entity compliant facility is still has less a 20-year or less recovery period, and so they would still be eligible for bonus depreciation.
All right, thank you. And again, I know we didn't get to everyone's questions because we are over, and we are going to be reaching out, following up with each one of you after the webinar to get those answers to you. We do have everyone's information on the screen, but please be reminded that the Washington National Tax Team cannot provide any additional advice without you being a client, but they're happy to assist when that time comes. This webinar was recorded. We're going to be sending it out after the webinar, so please keep an eye on your inbox because we're going to be sending that in the next couple of hours. And I just do want to mention again, if you are a user of Energy Toolbase, you can set up a call with your account manager. If you don't know who that is, log into the dashboard. On the right side of the screen, you are going to see who that is with their name, phone number, email, and you can message them. If you're not a user, we want to talk to you about your projects. Scan this QR code, or you can click that link when you get this slide deck, and that will lead you to a Calendly link to set up a call with our team of experts. These are people that have been working on projects all year, and they are happy to help you get these projects across the finish line. But I just want to say thank you again to John and Sean for being on with us. We really appreciate it. You have given so much helpful information, and we are happy that you're here with us today. And thank you again to Scott too. So John, Sean, any last parting words?
We just appreciate the opportunity to present. So thank you so much.
All right, well, thank you again, and thank you everyone for being here today. Keep an eye on your inbox. We will have all of this great info in there shortly. Have a great day.